Let's review chapters 19 to 21. So we have a few questions here in this review. Question number 1 says Lopez Corporation incurred the following costs while manufacturing its product. So there were materials used in the product, depreciation on the plant, right? So we have all of these costs that the company incurred while making their product. So we're also told our work in process inventory at January 1st was $12,000. And then at the end of the year, it was $15,500. Our finished goods inventory was $60,000 at January 1st and $45,600 at December 31st. And then our sales revenue for the year was $900,000. If you're watching this video back, I would recommend taking a picture on your phone or taking a screenshot right now, so that way you have all of this information as we go through each part of this problem. So we will need to compute a cost of goods manufactured, we need to compute cost of goods sold, and we need to prepare an income statement through gross profit. So before we go into all of that, let's look back up at the top with all of our different costs. And we can separate this into direct materials, direct labor, manufacturing overhead, or a period cost. Right? So a period cost is anything not associated with the production of the product itself. So materials used in the product. Well, that's going to be a direct material. That's a material that you can trace directly to the product. Depreciation on the plant, so on the factory, right? So since it's on the factory where the products are being made, it's manufacturing overhead. Property taxes on a store. Well, the store doesn't have anything to do with the manufacturing process. So since it's property taxes on a store, that's a period cost. Labor costs of assembly line workers. These are the workers who are putting together the product, right? So that's going to be our direct labor. Factory supplies used. So this is a cost of the supplies in the factory. Well, in the factory is where we make the product, so it's manufacturing overhead. Advertising expense. Advertising expense will help you sell more, possibly, but it's not going to have any impact on the manufacturing of the product. So that's going to be a period cost. Property taxes on the plant. So now these are the taxes on the factory. If you look at what we did earlier with property taxes on the store, those were a period cost because they were on the store. Here, since it's on the plant, on the factory itself, it's manufacturing overhead. Delivery expense. Well, once products are being delivered, they're no longer in the manufacturing process. So that's going to be a period cost. Salaries paid to sales clerks. These are employees who are outside of the factory, right? They are not making the product, so it's a period cost. And sales commissions, same idea there. This has to do with the sales process rather than the manufacturing process, so it's also a period cost. So we will need to know what we have for direct materials, direct labor, and manufacturing overhead as we go through parts A, B, and C of this problem. So the first part wanted us to compute our cost of goods manufactured. So we have our cost of goods manufactured schedule here on this screen. We start off with our work in process on January 1st. Well, we were told that our work in process on January 1st was 12,000. So we'll put that 12,000 there for our work in process at the start of the month. Now, our direct materials? Well, we go back up to all of our costs at the top of the screen, and we only labeled one as our direct materials. That was our materials used in the product. So that 120,000, that goes into your direct materials. Now, direct labor. We only labeled one cost as direct labor as well, your labor costs of assembly line workers. So that 110 goes into your direct labor. Now, manufacturing overhead, we had three separate manufacturing overhead pieces. We had depreciation on the plant, factory supplies used, and property taxes on the plant. So we need to add those up to figure out our total manufacturing overhead. So your depreciation on the plant was 60,000. Your factory supplies used was 23,000. And your property taxes on the plant was 14,000. You add those together and you get $97,000 for your total manufacturing overhead. So we can come back into our cost of goods manufactured schedule and put in the 97,000 as our manufacturing overhead. So our next line is the total manufacturing costs. So that's all of the product costs that you incurred. So that's your direct materials, direct labor, and manufacturing overhead. So we're going to take our 120,000 plus 110,000 plus 97,000. So the total manufacturing cost was $327,000. The next line is our total cost of work in process. Well, we started with 12,000, and then our manufacturing cost that year was 327,000. We add those together and we get our 339,000 for the total cost of work in process. And then it says less work in process December 31st. So we go back to the information that was given to us in the problem. It tells us that our work in process inventory on December 31st was 15,500. So we put 15,500 into that box. So our cost of goods manufactured will be the total cost of work in process less our ending work in process. So 339 minus 15,500, and we get a cost of goods manufactured of 323,500. So now part B wanted us to compute the cost of goods sold. So we're going to need a few different pieces from the problem to find our cost of goods sold. We have our cost of goods manufactured that we just found. And we have our beginning finished goods from January 1st, and then our ending finished goods from December 31st. So your cost of goods sold, you can calculate this by taking your beginning finished goods, so your finished goods on January 1st, adding in your cost of goods manufactured that you just calculated, and then we subtract our ending finished goods, the finished goods from December 31st. So we plug in our numbers. 60,000 plus 323,500 minus 45,600, and you'll find that your cost of goods sold is 337,900. Right? So that's a little bit simpler than finding your cost of goods manufactured, but it's important that you found that cost of goods manufactured to be able to figure out your cost of goods sold in this next part. So continuing to build on itself, the problem now says to prepare an income statement through gross profit. So you calculate gross profit by taking your sales, subtracting your cost of goods sold. So at the start of the problem, they told us that our sales revenue for the year was $900,000. So we'll put that in for sales. Then it told us that we need to subtract out our cost of goods sold. Well, we just calculated that. So we're going to subtract out 337,900. So we get a gross profit of $562,100. So that's question number one. We found our cost of goods manufactured, we found our cost of goods sold, and then we were able to find our gross profit. So let's move on to question number two. St. Clair Decorating uses a job order cost system to collect the costs of its interior decorating business. Each client's consultation is treated as a separate job. Overhead is applied to each job based on the number of decorator hours incurred. Then we have some information here for estimated and actual overhead and estimated and actual decorator hours. So we need to compute the predetermined overhead rate, determine the applied overhead for the year, and then determine whether the overhead was under or over applied and by how much. So your predetermined overhead rate. You'll find your predetermined overhead rate at the start of the year, right? So at the start of the year, you don't have your actual overhead yet, and you don't have your actual hours yet. So your predetermined overhead rate, you'll be using your estimated amounts to calculate this. So we take our estimated overhead, our dollar amount, and we divide that by our estimated decorator hours, or whatever your cost driver is in this scenario. So then this way, our overhead rate, our predetermined overhead rate, will give us a dollar per decorator hour answer. So if we plug in the numbers that we have here, $960,000 divided by 40,000 decorator hours gives us a predetermined overhead rate of $24 per decorator hour. So going into this year, we thought that each decorator hour was going to cost us $24 in overhead. Now, so that's your predetermined overhead rate. Part B wants us to determine the applied overhead. Well, for the applied overhead, what we do is we take our predetermined overhead rate and we multiply that by our actual hours. So your applied overhead is saying, okay, if it really was $24 per decorator hour and you actually worked 40,500 hours, what should your overhead be? So we plug in our numbers here. Our predetermined overhead rate of 24 an hour and our actual hours of 40,500. So our applied overhead is $972,000. So you'll notice your applied overhead does not equal your actual overhead. And that's okay. That's what part C is dealing with here. So part C wants to know, was it under or over applied and by how much? So our actual overhead was $982,800. At the end of the year, that's what we actually spent in overhead costs. Our applied overhead was $972,000. That's what we would have expected to spend based off of the number of decorator hours we had this year. So we take the difference between those two. 982,800 minus 972, and we get 10,800. So that's answering the by how much question, but it's not answering the under or over applied yet. So that's when we put under applied, because our applied overhead was under our actual. Right? If our applied overhead was $985,000, then we would have been over applied. But since we didn't apply enough, we are under applied by 10,800. So now question number 3. Question number 3 is a production cost report question. So it says the sanding department of Castle Company has the following production and manufacturing cost data for January 2020, the first month of operation. That's an important little phrase there at the end of that sentence. It says production was 7,000 units finished and transferred out, 3,000 units started that are 100% complete as to materials, and 20% complete as to conversion costs. Manufacturing costs, materials were $33,000, labor $21,000, and overhead $36,000. Again, we need to use all of this information to prepare a production cost report. Before we move on to that, let's go back to where it says conversion costs. What are conversion costs? Well, these are your labor and your overhead costs. They're the cost associated with converting raw materials into a finished product. So when you see conversion costs, think of it as combining labor and overhead. So this is a production cost report, right? We have all of the important information over on the left. Now we need to just start filling things in. So the first thing that it tells us under production is 7,000 units finished and transferred out. So we're going to be working up in just the quantities section right now. And if you see transferred out, well, they want the number of units. So we can put 7,000 units there under transferred out. And then you'll notice the next couple columns are for the equivalent units for materials and conversion costs. So there's some calculations here that we need to make. For units that are transferred out, if they are transferred out, that means that we have completed manufacturing process, right? We've completely made these units. They're ready to be transferred out. So they're 100% complete for materials and for conversion costs. Now, the next piece of information that we have is 3,000 units are started, but they're not all finished yet. So that's your ending work in process. So we can put the 3,000 there for our work in process at the end. Now, those 3,000 units, this is where these percentages come into play. We're told they're 100% complete as to materials. So all 100% goes into the materials column. For conversion costs, they're only 20% complete, right? So we haven't put in all of the labor and the overhead into these products yet. So that's why we're still working on them at the end of the year. So we take 20% of 3,000 and we get 600. So we put 600 there for the conversion cost ending work in process. Now, before we figure out our total units, let's go up to that part above where we've been working right now. We have units to be accounted for, our work in process at the beginning. Well, remember how I pointed out how important it is that it told us that this was the first month of operation? That's because we now know that we didn't have a beginning work in process. We didn't go into this month with any units having been worked on yet, because we just started as a company. So we have 0 under our beginning work in process. For started into production, well, this is where we need to calculate this a little bit. If we have transferred out 7,000 units, and we still have 3,000 units in our ending work in process, that means that we started into production 10,000 units. So we put 10,000 there for started into production. So now we can find our total units, right? 0 plus 10,000 is 10,000. Then 7,000 plus 3,000 equals 10,000. We can do that as well for our materials and for our conversion costs. So you'll notice that the 10,000 and 7,600 as the equivalent units for materials and conversion costs have now also shown up under the cost section of our production cost report. Under the equivalent units for materials, we take the 10,000 from above, and for conversion cost, we take the 7,600 from above. So now we are ready to work on cost. So we need the total cost for materials and then the total cost for conversion costs. So this is when we're looking over in the manufacturing costs information that was given to us. We're told that the materials was $33,000. So we'll toss 33,000 in there. For conversion costs, we said earlier those are your labor and overhead costs combined. So your labor is 21,000. Your overhead is 36,000. You add those together and you get $57,000. So your total cost altogether is $90,000. We get that by taking 33 plus 57. Now we can find our unit costs. To do that, we take our total divided by our equivalent units. So for materials, that's $33,000 divided by 10,000 units, which means that 1 unit of materials is going to cost $3.30. Now for your conversion costs, we'll take our 57,000, divide it by the 7,600, and the unit costs for conversion costs are $7.50. So 1 unit, 1 completed unit, will cost $10.80. We take our $3.30 for materials and our $7.50 for conversion costs. We add those together to get our $10.80. So now we can move on to this next section. We need to know what was the cost to be accounted for in our beginning work in process. Well, if you recall, your beginning work in process was 0. So we'll put another 0 in here for our beginning work in process. Your started into production, well, those were all of the manufacturing costs that we incurred throughout this time. So we had materials of 33, labor of 21, and overhead of 36. You add those together and you get 90,000. So 0 plus 90,000 equals $90,000. Now we can move on to the cost reconciliation schedule. So this is where we need to figure out what was the cost of our transferred out units and what was the cost of our ending work in process. So for transferred out, we take a look back up at the quantities section, and we notice that there were 7,000 units that were transferred out. And then we look at our total unit cost. Since every transferred out unit is fully complete, that means that each of those units cost a total of $10.80. So 7,000 units times $10.80 and you'll find that your transferred out had a cost of $75,600. So we'll do a similar process here for our ending work in process. For materials, we need to figure out how many units did we have in our ending work in process for materials. So again, we look back up at our quantities section and we see under ending work in process, we go over to the materials column and we see 3,000. So we have 3,000 units in our ending work in process for materials. We take that 3,000 and we multiply it by what our unit cost is for materials. So 3,000 times $3.30 gives you $9,900. Now for conversion costs, we see that the ending work in process only had 600 units. So we take our 600 units times our unit cost of $7.50, and we end up with 4,500. So the total cost of your work in process at the end was 14,400. We add together our materials and our conversion numbers. So now our total cost, the very bottom line of this production cost report. We're going to take our transferred out and add in our ending work in process. So 75,600 plus 14,400 gets you $90,000. And what do you notice there? All of our total cost lines equal. Every time that you found your total cost, it all came out to the same amount. That's going to happen on every production cost report that you make. It might not be 90,000, but those three boxes always have to equal. So now we can take a look at question number 4. So question 4 says Kelly Company identifies 3 activities in its manufacturing process: machine setups, machining, and inspections. Estimated annual overhead cost for each activity is $150,000, $325,000, and $87,500 respectively. The cost driver for each activity and the expected annual usage are 2,500 setups, 25,000 machine hours, and 1,750 inspections. We need to compute the overhead rate for each activity. So, we have this table set up. We break it up between each activity. We have machine setups, machining, and inspections. So our machine setups, our estimated annual overhead is $150,000. Our cost driver and our usage is 2,500 setups. So for our overhead rate, we're going to want a dollar per setup amount. So we take our estimated annual overhead and we divide it by our cost driver. So $150,000 divided by 2,500 setups gets us an overhead rate of $60 per setup. Now machining. So our estimated annual overhead was $325,000. Our cost driver and usage was 25,000 machine hours. If we take our annual overhead divided by our cost driver, we end up with $13 per machine hour. Now for inspections, we have our estimated annual overhead of $87,500, and we have our cost driver and usage of 1,750 inspections. We'll be going through the same steps here. we want a dollar per inspection amount. So if we divide our annual overhead by our cost driver, we end up with $50 per inspection. So a company might choose to find overhead rates for each activity rather than just a predetermined overhead rate like we found back in number 2, because here it's a little bit more personalized to each activity, right? There's some activities like machine setups and inspections where there's a lot more overhead per setup or per inspection than what we see in machining, where we only have $13 of overhead per hour. So if we tried to lump this all together to do a predetermined overhead rate, it's not going to be as exact for us. So that's one of the reasons that a company might choose to have overhead rates for each individual activity rather than one predetermined overhead rate for the company as a whole.